Hello, everyone, and welcome to the 2021 Better Buildings, Better Plants Summit. This is Joe Envik here, and I'm thrilled to be your host for a session on emerging trends and hot topics in clean energy finance. I often like to say that financing is a necessary but not sufficient condition for solving the climate crisis. And I think for many organizations like yours that have set ambitious energy reduction targets, there's a lot of factors that need to align to realize those targets. But at the end of the day, if there's no capital available, then the wrenches simply don't turn. But that being said, I would argue that clean energy finance can be a lot more than just capital availability. As we're going to hear from our panelists today, smart financing can transform the way that organizations get energy projects done in their facilities and help you deploy sustainability initiatives at scale and speed. So today we're going to be looking at 5 key trends that kind of show how the market is rising to meet that challenge. Before we dive in, there's a couple of housekeeping points that I want to cover. First is today's session is going to be recorded and it'll be posted to the Better Building Solutions Center for your future reference. We'll also let you know when it becomes available. And next, everyone is going to be on listen-only mode, meaning your microphones are going to be muted. So if you experience any audio or visual issues during the presentation, please send a message in your chat window located at the bottom of your Zoom panel. And if you go to the next slide, I'm Joe Envik. Great to be with you. I'm going to be the moderator today. I lead the clean energy finance and carbon solutions practice at Retech Advisors, which is a consulting firm here in the DC area. And also along with my colleague, Kyle Saltzman, who's running the slides today, we're the co-leads for the Better Buildings financing sector on behalf of DOE. So great to be with you guys today. If you go to the next slide, the agenda is pretty simple. I'm going to give some brief introductory remarks and background up front. Then we'll move and spend most of our time in speaker remarks. And then finally, have a Q&A at the end. So if you go to the next slide, we're going to be using an interactive platform called Slido for Q&A today, which you'll be familiar with if you've been to other sessions. So please right now go to www.slido.com using your mobile device or by opening a new window in your browser. And today's event code is going to be #DOE or #DOE if you're of the older persuasion. And if you want to ask our panelists any questions, please submit them in Slido at any time during the presentation, and we'll be answering your questions near the end of the session. So we're going to go ahead and open up Slido now. So please do that on your device. And we're going to launch a poll to get a sense for who's in the audience. So we can go ahead and launch that poll. And please indicate what sector you're from in the poll here. All right, government out to an early lead. Higher education catching up. Give it a couple more seconds here. Looks like we have a good mix. A lot of folks from state and local governments, wide range of contractors and service providers, it looks like. Good showing from higher education. A lot of others. I'm curious to hear more about that, who those folks are from in the Q&A. And then a good mix of nonprofits, industrial, financial services, and if we can scroll down a little bit, see who else is represented here. That's all good. So yeah, pretty good mix of folks. I think we can go back to the presentation. I think we'll have a little bit of something in here for everybody, for all sectors. So looking forward to diving in with you all. And just a reminder again, if you have any problems during the presentation, technical or otherwise, just make a note in the chat in the bottom of your Zoom window. And if you go to the next slide, I'm excited to say we've got a rockstar panel of speakers today with a wide range of backgrounds in clean energy finance. I'm going to introduce them more fully before each of their presentations, but we've got Brenna Walraven from CSS, Devesh Nirmul from Counterpointe, Donnel Baird from BlocPower, and Mark Orlowski from the Sustainable Endowments Institute. So welcome to all of them, and thank you for being with us today. Before we get started, I want to do a quick overview to kind of set the stage, and I like to use this slide to summarize the state of the clean energy finance marketplace and the financing options that are available. So on the left-hand side, you've got traditional financing solutions like loans and leases that have been around for a long time and are, of course, also being used to facilitate energy projects. And then on the right-hand side, you've got more specialized financing solutions. So these are tools specifically designed to help you do energy efficiency and renewable energy projects in your facilities. So that includes things like on-bill financing, where the customer repays on their utility bill, property assessed clean energy or PACE financing, where the customer repays on their property tax bill, various flavors of energy services contracts in which some sort of service is embedded with the financing arrangement. And then last but not least, up top, we have various types of internal funding arrangements, such as green revolving funds, as well as green bonds, which are a unique type of bond where the proceeds are used for sustainable purposes. So our speakers are going to cover many of these different mechanisms today, and I think this is a helpful way to kind of see how they fit into the broader landscape of options. Go to the next slide, and speaking of the landscape of options, I would highly suggest that you check out the Better Buildings Financing Navigator. So this is a tool that we developed in consultation with other Better Buildings partners to help you both understand and actually find and secure financing options for energy efficiency and renewable energy. So this is a great way to explore all the options available, find case studies and fact sheets, and I think most importantly, connect with the financial allies. So if you're not familiar, the financial allies are a group of about 50 financing institutions that have signed on to Better Buildings and are available to support projects in your facility. So you can connect with them directly through the Navigator as well. So you can check it out at the link below, or just Google Better Buildings Financing Navigator, which is a little easier, to be honest, and you can get to it that way as well. If you go to the next slide, I do want to also highlight the Finance and Resilience Initiative. So this is a resource, a toolkit specifically that we developed with Better Buildings partners that explores some of the financial implications of resilience and climate change risks on buildings. So it outlines a sort of 5-step roadmap to measure the financial risk of resilience-related impacts to your buildings, and then leverage third-party finance to build a modern resilience strategy. So highly recommend you check that out as well if you're in the process of developing a resilience plan. And if we go to the next slide, without further ado, here's the 5 trends that our speakers are going to cover today. So there's a lot happening in this market, as you can see, but these are the trends that we think represent some of the most important developments in clean energy finance over the past few years. So we're going to talk about how energy performance contracting, whereas it has been more common in MUSH, municipal, university, school, and hospital markets in the past, is now increasingly breaking into the commercial sector. So Brenna is going to talk about that. We'll talk about how PACE financing is rising to the dual challenge of COVID-19 and increasingly aggressive carbon and ESG targets in the built environment. And Devesh is going to talk about that. We'll cover how efficiency as a service is providing full service turnkey solutions to an increasingly wide range of energy retrofits, including HVAC projects. So Donnel is going to talk about that. We'll talk about how green bonds are becoming more commonplace and also more accessible at smaller issuance sizes. So Donnel is also going to cover that one. And then finally, we'll explore how internal investment programs like green revolving funds are unlocking measurable savings across building portfolios and enabling retrofits to happen at speed and scale, which Mark is going to cover. So let's get right into the speaker presentations. I'm going to hand it over to Brenna. If you go to the next slide, just for a bit of background, Brenna is an internationally recognized leader in commercial real estate and in the sustainability realm, also a dear friend and colleague of mine. She founded Corporate Sustainability Strategies in 2014, which is a firm dedicated to providing best practice solutions for organizations and helping them develop and implement business case focused environmental, social, and governance, or ESG strategies. So Brenna, over to you.
Awesome, thank you. Let's jump into it. And really, I'm going to start giving a little bit of kind of level setting with respect to real estate based on the experience of owners. So if you can go to the next slide, which is really this concept of risk. And I say newish because COVID has reset what we really think about when we say risk. But long story short here is real estate professionals are really used to dealing with risk around leasing and maintaining and managing real estate, but are really not as sophisticated around energy retrofit parts, retrofit implementation. Obviously, the most sophisticated real estate, most well-capitalized real estate companies do it well because they have internal expertise, capital. But those folks really represent a small segment of the entire market, less than 15 to 20%. And thus, for most owners and real estate operators, the tools we're going to talk about today actually create more opportunities to get more efficient. Next slide. The challenges for real estate owners and operators is often not only the lack of capital, but this how to execute, as I just touched on. I think we're increasingly seeing is the risk of doing nothing is real, and it's going to position buildings to be less competitive as the existing building stock ages, which creates uncertainty and additional problems. So it's not just efficiency for efficiency's sake, but for competitiveness. Next slide. And so how and why do owners and real estate operators consider third-party financing? Traditionally they look at their normal lending sources like banks, mortgage lenders, insurance companies, But these lenders aren't really overly familiar with efficiency, and really, unless it's part of an original refinancing or financing of a project, harder to use as a tool. And that's really to reinforce what Joe talked about. The DOE's Efficiency Navigator really helps give some focus and qualifying process, because we find often in real estate, folks tend to ask questions like, well, what's the interest rate or what's the term? And that's often not the most important question to ask. Next slide. So often the capital side of this challenge is the concept here is capital is finite, right? If there was infinite capital, we would do every efficiency project that had a rate of return that was higher than the underlying cap rate of the asset, because it would be accretive to value. So unfortunately, there are limits. And that's when these third-party financing options come into play. So what I've seen often, though, is even if there is some capital available, if it's not underwritten in the original investment pro forma, they really don't want to go back and say, hey, let's do this, because the question is going to be, well, did you miss something? Did you forget it? Why didn't you underwrite it? And so the other concern on capital is there are higher priority capital demands. So if you want to do leasing, for example, you need capital for tenant improvements, you need capital for leasing commissions, and those are always going to take priority over efficiency. And so this becomes another part of the capital challenge. Next slide. But what I find is getting to the right questions when you have those challenges. And it's not what is the interest rate or term, it's does the owner or operator need a non-recourse or no personal guarantee requirement for the financing? Does the debt need to be transferable or assignable on sale, which means for even a property that's not a long-term hold, that's a value add strategy where you're making improvements and going to sell it in a relatively short window. These financing models that we're going to be talking about today can make sense because you're able to transfer them in certain situations. So there's a whole host of questions here. This is something, if you go to the next slide, that the Efficiency Navigator can really help you walk through. And based on how you answer those questions will help you determine, this should be a CPACE project, or maybe this should be efficiency of service, or maybe we need to look at a green revolving fund. So it's a great tool to align with that. And then again, it helps you focus on the right factors for what's most important for the decision makers. Next slide. So let's talk about specifically energy performance contracting and really what is it is the first question. And it's really using a contract mechanism to pay for a retrofit project over time, paying for it out of the savings generated from that project. So the savings essentially pay for the project over time. There are benefits where you get to benefit from the technical expertise of the energy service company, which is often really important. So you don't use an energy performance contract if you're going to do a lighting retrofit, right? Pretty simple, straightforward. But if you need a more robust, complex project, which is, I think we're seeing more and more the opportunity today, that's where an ESCO can really bring creativity and expertise. There's no upfront costs typically in these models. And you can not only incorporate greening, like green roofs, but certifications and also resilience. So a lot of opportunities. Next slide. So this is a visual, because I'm a visual person, and I find this kind of helpful to really explain what the performance contract model really does. Is the big blue bar at the far left is your energy costs at day one before you've done the retrofit. And when you contemplate the retrofit, the opportunity here is, hey, my energy costs are going to get driven down significantly. And then part of that savings I'm going to use to pay back and pay for that retrofit cost over time, which is those, years 1 through 7 or 1 through 10, something like that. And that's paid to the energy services company. But it's structured such that there's typically a little savings left over. So the net effect is, even without something budgeted, no capital up front, you get savings in year one. And then once the contract is paid off, you get savings over the long term. Next slide. So a risk mitigator that I personally worked on closely is the BOMA Energy Performance Contract Model Toolkit, or BEPC, pronounced like Pepsi, but with a B as in boy. So what is it? It's an industry-vetted, proven process to procure and implement proven low-risk energy retrofit project. Actually, the picture there you see of the Empire State Building was actually, you probably have seen and heard about this over the last 10 years or so, but that retrofit project, we use the contract and process developed to do that project to develop BEPC. So we looked at industry best practices for RFPs, RFQs, how to develop scopes of work, et cetera. And really the big thing that I want to share is it's in a complete toolkit, not just a contract. So it provides a sample contract as well as a exhibit form contract. So you can use your existing contract document and then as an exhibit, use the BEPC template, which has things for measurement and verification and tracking efficiency, but it makes you an expert without having to have that internal expertise. The best part about it is free at boma.org/BEPC. So look for that. And if we go to the next slide, the home stretch here for me is really what the guiding principles for BEPC are. It's to take owners' investment criteria and core goals to determine project scope. So instead of saying, hey, I need a chiller and I'm going to go have an ESCO give me a proposal, you may say, hey, I know I need some equipment replacements, but I'd like you to use your expertise and creativity and innovation to come up with a holistic project. And instead of just saying, I want these 3 things to be replaced, I'd like you to meet a return on investment hurdle rate of 15% or better, or 10% or better, which is often going to be higher than the underlying rate of capitalization that the property is valued at, which means it's accretive. And that allows your energy performance contract provider to really be creative and innovative. The good news is BEPC provides third-party standards and transparency into the performance, but does allow you flexibility, because if you don't want a performance guarantee for the entire 10-year term of an agreement or 7-year, you can have it for 1 year. So you make sure the equipment is installed and working and operating and getting the savings, and then you don't need to pay for that M&B. Although I always recommend the M&B to make sure that those savings persist over time, BEPC is designed to give you flexibility. And then the last point here is that BEPC is financing agnostic, which means it can work with any of the processes and best practice trends that we're going to talk about today. So you can use your owner's capitals, you can work it with CPACE. It's just designed to be a contracting template and process that helps you get through the process and gives you that expertise to de-risk the opportunity. With that, I'll pause and turn it back to my colleague, Joe.
Wonderful. Thank you, Brenna. That was great. I see a couple of questions rolling in already, but remember, you can ask questions on Slido at any point during the presentation. If we go to the next slide, I'm going to hand it over to Devesh here. So Devesh is Vice President at Counterpointe SRE, which is a provider of turnkey solutions for property assessed clean energy, or PACE, for municipalities, program managers, and administrators. He's going to be talking about some of the recent trends in the commercial PACE market. So Devesh, take it away.
Great, thank you. Great to be here, and excited to kind of join this panel and provide some empirical-based review of some evolving and trending opportunities for building ownerships and product developers to basically leverage what is the financial alchemy of PACE, but also what can be the market transforming energy resiliency outcomes that come out of that. Next slide, please. So just to kind of review some of the buttons that are being pushed here with this discussion overall, but also what hits PACE in particular. Certainly in the capital markets, we've seen some major increase in appetite for ESG, and downstream those impacts are driving a lot of investment in this direction. I can take a quote from, for example, Blackstone, with their new investments having to be 15% reduction in carbon emissions within the first 3 years for that asset. COVID also has highlighted, the opportunity to upgrade a building and make it post-pandemic friendly. And the trick is, how do you do that in a credit-constrained, CapEx-constrained environment? I think distressed assets have always been an opportunity for a financing tool that can come in and allow a property to be stabilized, so an owner can actually, make the investments without having to take on the burden of the initial payment. Through PACE, you can have a payment that comes out a bit later in the cycle of the life cycle. And then we see technology advancements, and then public information. A lot of the grading that's going on in the public sector of buildings and their energy performance, and sort of the push for audits, and then of course upgrades. All that improvement from the audit, from the soft costs to the actual hard costs, can also be funded through commercial PACE. Next slide, please. So then the other key piece is net zero. And let me make this personal for myself. I mean, I know with COVID, we all saw the amazing resiliency of the natural environment to recover when the lockdown went through. The challenge is, how do we maintain a productive society and still have those kind of results? And the answer is, you've got to have market transformation. And we use that term over and over, but in terms of energy, that means something transformational that can really get those emissions down. And net zero is a great way to kind of, have a good soundbite that has true meaning behind it in terms of the goal. It's very empirical. So that's that. And then, with the ESG push, naturally, we're hearing more and more. It's the robust metric of how much kilowatt is being installed of solar that is driving a lot of the ESG targets. And so, certainly that's pushing the net zero case. Some other key observations in this marketplace, certainly OpEx. How do you get, if you want to reduce OpEx, how do you do that in a way that you get positive or neutral net cash flows from doing that? And because of the long-term fixed rate financing that PACE offers, that's an opportunity. Business continuity. How do you maintain operations when the power goes out, et cetera? How do you view the idea of net zero as a combined costs reduction mechanism, as well as revenue generating potentially? And then CSR mandates. We have an industrial client that said, let's try out solar and see if that has an impact. And because it did have an impact, they're more confident to say, now we can move forward with net zero as a publicly transparent objective and replicate this on other facilities. Next slide, please. So just stepping back for a moment, if you're not fully aware of how PACE works, there's a great, as Joe had mentioned, the Financial Navigator. There's a link here, particularly to the CPACE handout review on that. Here at the bottom, it's kind of small, but if you go to the Navigator, you'll be able to get to that. But some key relevant points here. The repayment is through a non-EVRM assessment on the tax bill, which kind of creates the off-balance sheet nature of this financing. No upfront CapEx required. And even when it is available, they can divert that owners to mission critical investments. It's long-term fixed rate, as I said. It's non-recourse. Anyhow, but if you want to look now to how we would leverage this, the key decision points, if there's value engineering on the table, this is a great way to mitigate that. And I like to call value engineering devalue engineering rather than value engineering. So if you have the opportunity not to devalue something, great, go for it. Some of the other key pieces here with this would be certainly, I mentioned the CapEx constraint, and even if you were going to sell the property in a couple of years, you can impact the NOI dramatically with PACE and extend out payments in the long run. And it can be assumed with the new owner. And expanding the scope of projects to actually include integrated measures that support each other and get you a better overall performance. Next slide. At the macro level on PACE trends, we're seeing an expansion across the country. We're also seeing a continued focus on new construction. Then within the sectors, multifamily and the affordable subcategory of that in progress with HUD is also noteworthy. And then for today's presentation, retroactive PACE is one of the key subjects, and it has to do with the COVID period, with the constrained credit market, and the opportunity to continue with projects and not to devalue engineer, as I mentioned, and then the net zero sort of aspirational piece. Next slide. So retroactive. So the idea here is that you certainly can look back at a project and actually pull capital out, or in the case of an example we have, make sure a project continues as intended. I know this is kind of small here in terms of the text, but the idea is in most states you can actually go back 2 to 3 years and PACE anything that was qualified and pull cash out. And this is a good launching point for doing other work as well and doing more robust projects. Next slide. So here's an example of a mid-construction finance where this is exactly what happened in 2020. We had a project where there were cost overruns. The owner came to us wanting to be able to continue with their high-performance features. And instead of deval engineering out that, they were able to do that with the PACE piece. In this case, 13.7 million over 30 years. That's the long-term nature of this. A lot of, let's see, yeah, obviously quite a variety of improvements here coming together. Next slide. So overall, we think, you've got a couple things going on. You've got the retro piece, as I mentioned. You've got, in terms of trend, the bundling of ECM. So having the opportunity to bundle and not just do piecemeal has been there, and I think we're only seeing that enhanced. And then net zero, and I think both the retro and bundling are good launching pads to get to net zero. The discussion on that. Next slide. Here's an example of a bundled retrofit. This is a nursing home ALF. Initially, the big point here, the initial scope that the project developer provided was for about 1 million of improvements. They went to 3.7 million with PACE, which is a 3 times multiplier. And this was able to get to your standard burger, shakes, and fries, as we like to call it, your HVAC, lighting, controls, and some generator work. So let's go to the next slide. I know I'm kind of running out of time, so when I move ahead, I can come back. This is the actual net zero scenario. And I'd like to go ahead and play a video because I think the previous bundling scenario could have led to a net zero opportunity as well.
CPACE and what you guys are doing is tremendously the thing that's getting us over the hump.
What is the most common problem you see in the energy efficiency and renewable space?
Fundamental problem is this: decision makers are stuck. So the solution to that is to have a way to do the report, the technological advanced stuff, and have a financial mechanism that right from the get-go shows the cash analysis that lets people see it to a CEO, a CFO.
So thank you for that. And I just want to echo what Brenna was saying. So certainly, in this situation, a project developer approached the owner and they were like, well, look, we don't have the CapEx to spend this couple of million to get this thing to be super energy efficient. But when they realized that the value of the building would increase roughly about 3 million from 7.6 to about 12 million, they're like, great, this is and without any CapEx, they're like, let's go ahead and do it. And so there's different paths to getting to the net zero goal based on different objectives that are both financial and resiliency related, and the market pressures that come from external, as I mentioned. So they were able to keep all their utility incentives here, combined with tax credits, and the tenants are happy and satisfied. They're getting a lower energy bill as a result. Next slide, please. So when you think of net zero drivers, initially this was going to be a spaghetti kind of diagram with linking all these stakeholders to the different catalysts, et cetera. It really is spaghetti because there's all kinds of drivers. So an owner may have climate and environmental leadership issues. Sorry, that was my alarm. And anyways, so I just want people to think openly about when we have conversations with owners, when we ask, what about net zero? They're not so much why, but they're how do we get there is really what we end up talking about.
Amazing. Thanks, Devesh. Really appreciate it. So keep the questions coming. There's a ton in there already, but be sure to upvote the questions that you want or add your new questions as well. I'm going to pass it over to Donnel next. So Donnel is the founder and CEO of BlocPower, a smart buildings platform that brings innovative financing solutions such as efficiency as a service to underserved market segments. You might recognize him from the roundtable after the plenary session yesterday. So welcome back, Donnel. And BlocPower also has a unique model that leverages green bonds to raise capital for the efficiency projects that they install. So he's going to be doing double duty today, discussing both efficiency as a service and green bonds during his remarks. So over to you, Donnel.
17 minutes, we'll get it done. Glad to be here with all of you. We are here to talk about financing solutions for building retrofits, and in particular, building decarbonization and electrification. So I'm Donnel. I started BlocPower 7 years ago, was fortunate to partner with the Department of Energy with an early contract that we won to help build a lot of the stuff that we're going to talk about today. Slide. So we're going to outline the challenge as we see it, which others have talked about extensively. We're going to talk about the specifics of our solution and the solution that we think can create a lot of impact across the market, the specifics of the financing model, and what we see as the road ahead. Slide. Slide. So the challenge, we all know that buildings across the country are incredibly energy inefficient. They're also super unhealthy. And so those are two great reasons to do upgrades. For small and medium enterprise buildings, we know there's about 5 million of them. Their energy systems are old, outdated, hyper inefficient. They consume 40 to 75% more energy than they should. And, you know, as many as 30% of people experience sick building syndrome, where the building is making them sick. It's a lot of people. Slide. So the other part of the problem, in our view, is when we provide services to building owners, or try to, an individual property owner has to navigate anywhere between 6 and 12 different service providers in order to complete a deep decarbonization project of their building. So they have to talk to engineers of different kinds, whether it's mechanical or electrical, sometimes chemical. They have to talk to a construction contractor to get to a scope of work. You may have to talk to multiple sub-construction contractors who specialize in mechanical or electrical or plumbing. You have to purchase the equipment. It needs to be the right size. Hopefully your engineers help you with that. Then you have to access financing because many building owners around the country don't have hundreds of thousands of dollars or millions of dollars laying around. So that's why we're having this conversation today. Then you got to work with your utility company to access the range of incentives and permits that are needed or available. Then you got to get another permit from the government. So it's pretty complicated to ask all of the building owners across the country to navigate this highly fragmented and highly inefficient matrix in order to figure out what the right thing to do with their building is and then implement the solution. And so Brenna talked about the turnkey services of ESCOs, but they don't serve everybody. They serve bigger buildings. So what do we do with the remaining, millions of buildings across the country? Slide. So we know that the cost of not upgrading these buildings is massive. And so you can see energy costs rise as high as 30% of a small and medium buildings budget, particularly in low and moderate income buildings, in buildings that are in communities that are financially underserved, where they've had lack of access to capital. You can see energy bills taking up an enormous share of overall building budget. And so I started BlocPower because our first project was a pastor who 30% of the total revenue for the church was going to pay for oil to heat the building and provide hot water. And that just didn't make sense to me. So it's a pretty big problem. Slide. So our solution, slide, is, next slide. When we look at efficiency as a service, the first of the two concepts we're going to talk about today. So efficiency as a service, by that we mean a pay-for-performance, off-balance sheet financing solution that will allow building owners and customers to implement energy and water and renewable energy projects with no upfront capital expenditures. We as a provider, or your existing provider, is going to pay for project development, construction, maintenance, as well as engineering analysis. So we're going to roll up all of the 6 to 12 services that you need to talk to as a building owner and provide a one-stop turnkey solution so that the building owner only has to talk to one person. And that one point of contact is going to help them make the decision, going to provide engineering, going to provide financing, going to provide construction, going to provide project management, that one-stop solution is going to solve the whole energy efficiency and decarbonization problem for that building owner. Next slide. In our view, we got to acquire customers and new projects. We have to analyze each and every project on an individual basis because they're all custom. We have to finance the projects. We have to construct and install the projects. And of course, we have to measure and verify and monitor the performance of the project. So we believe that machine learning and the collapse in the cost of mobile computing, cloud computing, and machine learning as a new emerging computing platform, this allows us to take all of the data from all of the smart devices that are now in our buildings and do lots of the engineering analysis using computer software and data. And so we can save a lot of time, money, and friction by utilizing software technology. And then, of course, zero money down financing is really important in communities that have been financially underserved, where they don't have access to capital. And so we look to lease equipment, zero money down, to building owners, particularly in low-income communities. So we stretch out the payments. As Brenna was saying, we're going to achieve a certain amount of energy savings. We're going to stretch that out. You're going to take some of your energy savings and repay your lease and your loan over time. And because we're stretching that payment out, we're amortizing it over 12 to 15 years. That's what makes this affordable, kind of like a green mortgage. Next slide. So here we talk a little bit about the way we think about software, which is we all need to be doing predictive modeling, building archetype, type of clean energy equipment, environmental justice. Is the project in a community that needs environmental justice? If so, we know there's probably going to be mold, lead, asbestos that's in the building. That's going to increase your project costs. That's going to stretch out your repayment period and your timeline. You need to be aware of that. So you can build a recommendation for each and every building in each and every market that's based on software and big data. Slide. So how do we finance this stuff? Slide. The fundamentals of our model, and we've spent 4 years developing a plan to launch a new structured financial product with Goldman Sachs, which we're happy to share with all of you today. So we think it's got to be zero money down because we're serving low-income buildings. We think you got to stretch things out to about a 15-year term, so mortgage-like, right? You want to do the underwriting not based on the FICO score, but based on the history of payments that building owner has made on their energy bill. There's lots of people who have bad FICO scores because they got high credit card debt, so their FICO score is terrible, but they're still doing a great job of repaying their utility bill every month. So we want our financial underwriting to not just look at their FICO score. We want to also incorporate, are they paying their rent on time? Are they paying their cable bill on time? Cell phone bill on time? Are they paying their energy costs on time? Because that's the business we're in, energy. We want the customer payments to be lower than the savings that are generated, and Brenna outlined that. So we got this graph in the lower right-hand corner that you can look at quickly. We include all the cost of maintenance and repairs for the upkeep of that equipment and its proper performance over 15 years. We guarantee its performance. It's guaranteed to function for the full term, or we will replace it. However, we do not guarantee the savings. We predict the savings, we project the savings, we do not guarantee the savings. The equipment is owned by the customer at the end of the term of the 15-year lease. The equipment is transferred into the ownership. So it's almost like a lease to own model. If you think about going out and buying a new Tesla, you want to lease it, you want to lease to own. That's what we're doing with our heat pump and energy efficiency and building decarbonization equipment for low-income communities. You lease it till you own it. So you buy it out at the end of the term for $1, it's yours. And so we call this an energy services agreement legally, but effectively it's an operating lease. Slide. So those are the fundamentals of how we look at it. With Goldman, we have a debt service coverage ratio of 1.2x, debt to equity 80% or less, no major bankruptcies, judgments, or liens. And we're looking to serve multifamily buildings, houses of worship, community buildings, schools, churches, synagogues, mosques, restaurants, small businesses, some single family homes. Our other major partner is an incredible firm called Inclusive Prosperity Capital. They're amazing. I'd strongly recommend you reaching out to us and to them if you're interested in putting together a financing program. Amazing folks. Next slide. This goes through a little bit of the unit economics, but I think Brenna's slide was much better than mine, so we'll just keep moving. This is just a quantitative version of the great bar graph she presented about capturing savings and spreading them out and using a portion of it to repay the cost of the lease. Next slide. So the point is, now that we've slashed all of the friction and hyper inefficiency of building owners in America accessing green equipment and energy efficiency and electrification upgrades, we've been able in New York City at BlocPower to reduce some of the soft costs of green buildings projects by up to 90%. And we think that's exciting because it means that these kinds of models, particularly in low-income communities, now mean that the millions of small and medium enterprise buildings that traditionally aren't served by ESCOs can now get that kind of service and have it financed by Wall Street. And so we're excited because these millions of community buildings and medium-sized buildings can now access financing and the software and construction and the engineering that they need in order to reduce their emissions by 70 or 80%. Next slide. The road ahead slide. For us, this all culminates as we're going to launch the first ever BlocPower climate justice bond. We're going to be working with big corporations. I think I can name one of them, potentially Microsoft, people like that. We're going to raise what is in effect an environmental justice financing green bond. We hope all of you can join us, or if you're interested, let us know. We'd be happy to set you up, or if you'd like to raise your own local green bond. The way we think about it is green bonds are one of the most exciting financial products on the market today. They are like conventional bonds, except that the issuer promises to use 100% of the capital that's raised for green investments, for green projects, or eligible green assets. And so 100% of the capital from this climate justice impact green bond is going to be invested in building electrification and heat pump projects in low-income communities across the country. And that's going to help us with environmental justice, racial justice. It's going to provide flexible capital for green projects. We're going to be investing in low-income communities across the country. And we're going to be generating a bunch of carbon offsets, which are going to be cool because they're generated not in some forest off in the Amazon rainforest or whatever, but right here in America in Detroit, or better yet, in Flint, Michigan, because we're going in and we're electrifying buildings and we're also removing the lead out of the building. So we're going to be creating jobs, reducing greenhouse gas emissions, and creating carbon offsets to quantify that. And that's going to be an environmental justice carbon offset that comes out of the environmental justice green bond. And so we think that corporate partners like Goldman or Salesforce or Microsoft, some of our existing partners, are interested in these kinds of things. And for those of you who have great corporate partners in your local communities who are concerned about climate, who are concerned about racial justice, a green bond model, an environmental justice impact bond, might be a great thing for you to consider. Next slide. So we're going to raise 50 to 100 million. It's going to produce the carbon offsets and the environmental justice credits that we talked about, and it's going to offer people a 4.75 rate of return on the capital that they invest. And so we'll be using the model that we've described here to help allocate financing to low-income communities across the country. And so we want folks to join us in figuring out how to bring clean energy to low-income communities. Next slide. So what's left as we round the bend here? We got to electrify the 5 million buildings soon. I think it's great that people are talking about commitments 15 years from now, 20 years from now. We need cities to step up and say that they're going to go 100% green within the next 5 years. We need 4, 5, 6 American cities. We need some mayors with some political courage to stand up and make this commitment publicly. Maybe one of you is out there today as part of the audience. We know that we have to expand accessibility through cost reduction to serve low-income customers. We need a bunch of data for that. So we need to aggregate data from local municipalities. We need financial partners to provide 15-year loans in order to pull this off. Folks like to do 5-year loans. We need 15-year loans. And that's what it's going to take to electrify these buildings across the country and help President Biden reach these goals. Next slide. So with that, I'll wrap up and just say a lot of the financing solutions and needs are encapsulated in the Climate Accelerator Bank, the Innovation Accelerator. That's part of the President's infrastructure plan. I hope that we all take a look at that, because that kind of policy is critical to expanding capital to low-income communities.
All right, thanks, Donnel. Great, I think we're actually going to start with Mark's slides here, if we could go to those. So if any folks have questions for Donnel, feel free to enter them in Slido. Lots of great questions coming in. Keep upvoting. Here, I'm going to kick it over to Mark Orlowski next. So Mark's the executive director and founder of the Sustainable Endowments Institute, which is devoted to helping organizations, particularly colleges, implement sweeping efficiency improvements. He's going to be presenting SEI's GRITS tool, which is designed to assist with tracking green revolving funds and other internal investment programs. So Mark, over to you.
Great. Thank you, Joe, and good to be with all of you this afternoon. Really appreciate it and excited to be sharing with a little more about our work. SEI is celebrating its 16th anniversary this year, which we're very enthusiastic about, and continue to work a lot with higher education institutions and with a variety of others across local, county, and state governments, cultural institutions, healthcare institutions, K-12, so the corporate sector, and elsewhere. I'll be talking a bit about green revolving funds today, and also about our GRITS tool in a minute. Some of you might be already familiar with the revolving fund model, either as it relates to energy or as it relates to other topics. For those of you that are not familiar, next slide. Next slide. The revolving fund model is basically pretty straightforward. It's an internal funding or financing mechanism where essentially you're capturing either all or a portion of the savings in reduced utility costs that you have achieved from implementing a project and returning it back to the same fund, thereby using the same capital over and over again, recycling or revolving the same capital. This could be for a very small project as little as $1,000 or less, or a multi-million dollar projects. Revolving funds come in many shapes and sizes, and they can be implemented with different focus areas around efficiency, around renewables, around water, around waste, transportation, and fleet. They have been implemented by many hundreds of institutions over the years. I'll be talking about that more in a minute. Next slide. Back. There we go. So why would you want to do a revolving fund, right? We've heard there's a number of great sort of financing models and mechanisms out there. Revolving funds are a little bit different than sort of going outside. They're typically sort of you're turning inward in terms of setting up your own fund. You potentially can sort of bring in outside capital from a variety of third parties. But revolving funds, in essence, are typically an internal tool used by universities, by hospitals and healthcare systems, by governments and corporations and others. And essentially, they're helping sort of pull out this type of work from the typical sort of capital expenditure budget, where you're engaging and having to sort of fight a budget battle year after year to get a reasonable budget allocation to keep doing more of this work, and sort of setting aside the capital into a separate fund within your existing organization or company or institution. It's pulling out of that budget process. It's institutionalizing the mechanism for reinvesting. It's also sort of obviously instituting and forcing a certain level of performance tracking, because you need to be able to track performance and return savings back to the fund. You can start really small in terms of scalability. There's many revolving funds that are $25,000 or less in size, and there's many that are many, many millions of dollars or tens of millions of dollars. The next slide. So just to give you a sense of the scale of these revolving funds, we have a program called the $1 Billion Green Challenge, and it has a wide range of institutions, everything from a very small community in British Columbia called the District of Summerland, which has a $30,000 revolving fund they've been running for the past 4 years or so, to the Cleveland Clinic, the state of Vermont, and Harvard. There was one of the largest revolving funds out there is actually in Texas. It's been around for about 30 years now. It's called the Texas Lone Star Program, and it's done over $500 million in loans, $546 million in loans, and generated more than $700 million in savings over the years. So revolving funds definitely come in all shapes and sizes, different institutions. Next slide. So in terms of metrics, these are a couple of screenshots from public dashboards from different universities that are running revolving funds that use our GRITS platform. We'll be talking more about what the GRITS platform is and sort of how it works and some key features as part of a quick tour in a few minutes here. But essentially, you can see here with these dashboards a little bit about what kind of, the number of projects each of these universities have done, how much they've invested, their ROI numbers, their payback numbers, their carbon saving figures, other sort of key metrics. Next slide. Now, we don't have time to go into all these details, but I did want to briefly highlight a little bit about the process that one can go through in setting up a revolving fund. It is fairly straightforward. It takes a little bit of work. It's not something you can do overnight, but it is sort of a well-developed sort of pathway or a roadmap. At the bottom, and we'll cover this in a minute with resources, but there's a couple of implementation guides. Joe is actually the lead author of this one, Green Revolving Funds, introductory guide to implementation and management. And so this guide sort of covers these 10 steps to establishing a revolving fund. I think it's important to note that one of the key aspects around a revolving fund is it's very flexible in terms of size, as well as the types of projects you're funding, but also the capital sources. So there's probably a dozen different easily capital sources that have been used by different institutions to seed revolving funds. Everything from an endowment, if an institution has one, as an investment, to cash reserves. University of Vermont runs a $13 million fund borrowing from their own cash reserves, to philanthropic support from grants or individual donations, to third-party bond issuances or other third-party financing, to a variety of other mechanisms. So that's an important point, but we don't have time today to go into all these steps, but that's sort of the quick roadmap, and I'd encourage you to check out both that implementation guide and the next slide. You can see more on sort of other resources. We have a whole set of case studies, trends reports, white papers, etc. There's also a great toolkit on the Better Buildings Challenge / Better Buildings Initiative website, which I'd encourage you to include. And I think we're going to be putting in a couple of links here. Someone on the team's going to be adding a couple of links here in the chat if anyone wants to go visit a couple of these different pages. There's 2 implementation guides that you definitely should refer to if you're interested in sort of diving into revolving funds and considering setting one up at your own institution. One is the Green Revolving Funds Guide to Implementation and Management, which is the bottom one, the bottom right corner of the screen. And then the upper right corner of the screen is the second guide, more recently published just in 2019, that was funded through some federal funding in partnership with Cadmus Group and Rocky Mountain Institute. 3 of us teamed up and wrote this guide. Technically for airports, but about 80 or 90% of it's very relevant to any really sector, from universities to governments to corporate to the rest of the sort of K-12 school world, healthcare, et cetera, cultural institutions. One other big piece of all of this, though, is the data side, as you can imagine, making the business case, sort of tracking the impacts, figuring out the financial returns, managing these kind of funds. And so back in 2011, 2012, we received support from the Kresge Foundation and a bunch of other foundations, and began work on building this pretty ambitious platform called GRITS, which at the time stood for Green Revolving Investment Tracking System, but we just call it GRITS now. And the idea behind GRITS is to make it really easy to manage and track all the kind of data related to tracking projects, but also the revolving funds themselves. And the tool has grown a lot over the years in terms of its functionality, in terms of its capabilities, and now there's over 800 institutions that use it. The majority of which, funny enough, actually do not have revolving funds. They're just using it to track projects regardless of capital source. So I thought the last few minutes here before wrapping up, I would take you through a little bit of sort of what we're working on and what we've developed with the GRITS platform. So if we can flip over to the live screen share, that would be great. So this is a high wire act. We're doing this live, folks. So this is the GRITS platform that we built in a sample account. And just to give you a quick sense of it, we're looking at it could be a university, a company, a hospital, a local city government. You can see the dashboard view of your revolving fund and what you currently have invested and what you have available, a quick view of invested and saved, a bunch of metrics around ROI and carbon savings and water savings and the resource savings, as well as data on your own sort of account balance and rebates and other incentives that have been sort of achieved through projects that you funded. The project section shows you all of your own projects in terms of median figures, in terms of totals. If you just want to look at your planned projects, you can go in here and choose proposed projects only and look at that. If you only want to look at lighting projects or HVAC projects, you can go in and only choose lighting projects, for example, or just look up LED lighting projects. You can also do keyword searches like that. We'll upload data into the tools, so on and so forth. The project details page is where you find sort of all the details about a project. This is where you can track repayments to the revolving fund, rebates, expenditures. To take you through this briefly, you can track a wide range of project types and subtypes, about 120 in all. You can track all sorts of different resources from electricity to steam to other building-related resources, transportation-related resources, et cetera, et cetera. There's also a section on measurement and verification. How are you doing that? Annual tracking data. There's the ability to also share projects, both individually and a shareable library. So you can open up that and you can easily see, more of a shareable link format where anyone can look at this. A lot of universities and others like Cornell are very active in using that. They have a whole set of their website, which shows you a live dashboard view of GRITS' activity. They've invested over $46 million in projects at Cornell. They saved over 234,000 metric tons of carbon. They're sharing individual graphs here, and they're sharing also individual projects, all sorts of projects from different projects around the institution. So that's that. The library is where you find other people's projects. This is shareable only for sort of nonprofit and governmental entities, not on the for-profit side. It's over 3,000 projects in the shared library right now, and this is live data, where 15% annual ROI. With a median project size of just under $15,000. And so you can go look up by facility types, you can go look up by project types, by geographic area, by all sorts of other metrics. So that's that. There's also the reports feature where you can do charting and graphing based on impacts and based on carbon savings impacts or financial or energy. You can see here, you can mouse over anything you want, redraw these kind of charts on the fly very easily, and then easily sort of download them as image files in a couple of seconds. Be looking at what you just created, for example. So that's pretty simple. You also, in the new features of GRITS goals, and thanks to support from the NYSERDA and other supporters, we had funding to build out a whole scenario planning feature in GRITS. We don't have time to go into all the details right now, but essentially you can build out whole models around emissions reduction or energy efficiency. You can see business as usual. You can see abatement curves. You have sort of Gantt chart timelines. You have impacts automatically calculated for you, and all sorts of other abilities to sort of interact with and plan out emissions reductions and energy efficiency targets, whether they be short-term in the next few years or maybe long-term net zero by 2030 or 2040 targets. You can plan all those out and figure out the financials, the energy, the carbon pieces, and look at all the returns. So I think with that, I will wrap up. I know we want to leave plenty of time for questions and discussions here. So I'll turn it back over to Joe, and looking forward to the discussion and the questions.
Awesome. Thanks a ton, Mark. That was great. All right. So we're going to get into Q&A right away. So we have about 15 minutes here. So again, if you haven't already, please go to slido.com, enter the event code #DOE, and select 5 key trends in energy finance from the drop-down menu on the top right. Go ahead and submit your questions or like any of the existing questions. We've got way more than we're ever going to get to in 15 minutes already. So thanks for all the great questions. We're going to go through a few for each individual panelist, and then we'll have some general questions for the whole group as well. So maybe starting with Brenna, a good question here about the energy performance contracting model. So they asked, how would retrofit project returns be determined under an EPC or ESPC model? For example, if you were to add, air handlers where they don't exist, how would the return be quantified in contract terms?
Yeah, great question, and amazing presentations today. So thanks everybody for putting this together. So the way to think about it, and I'm going to give you a tool as part of this, is that you're really going to look at performance of your costs. So energy costs, there could be some maintenance costs, all the costs associated with operating the property that might go down because you're adding variable speed drives on these air handlers. And you want to look at that delta between costs before the air handler had the VFD and after, and that savings plus, because I saw another questions on rebates, you can include rebates as part of this and require the service provider, the ESCO, to secure and include rebates as part of your project. And then you get to a net cost. And that's essentially what's going to be in the contract is here's the project we're going to do. Here's the cost we expect to save. You can have a guarantee or not. That's up to you. You have flexibility using the BOMA energy efficiency contract or the BOMA energy performance contract model or BEPC. And so how you calculate the returns is savings divided by that cost gives you a return on investment. But there's a tool that I'll just point you to, and then I'll turn it back, is on US EPA's Energy Star website. You can look for the Building Upgrade Value Calculator, BUVC, and that will actually be an Excel-based form that you can plug in the numbers and it'll calculate it for you. Boom.
Great. Love calculators. Thanks, Brenna. Question for Devesh. So we had a couple of questions in here about commercial PACE eligibility and what types of organizations it can apply to. And you touched on this a little bit, but if you could go a little bit deeper into particularly what sectors of organizations can make use of CPACE. And we had a specific question in here about whether a municipal government could make use as a borrower on CPACE financing.
Sure thing. Thank you for the question. Predominantly, it's privately owned property, and that could be private business or nonprofit.
I know that a little bit of echo. If everybody just make sure you're on mute, please, except Devesh, obviously. Thanks.
Okay. Yeah, hopefully it wasn't me. So once again, privately owned property, nonprofit or private business are able to pay the non-ad valorem assessment on the tax bill. There's some innovation going on in Ohio where municipalities are being able to start to use PACE. There's a particular law firm involved in enabling those transactions, and so they have a way to do an assessment. So that is starting to happen. Yep.
Gotcha. You still sound a little bit like you're on a sports arena announcement system to me, anyway. And I think that's just on my end, but I can still hear you though. So thanks.
Sorry about that.
No worries. Donnel, question for you. So folks said a BlocPower, interesting concept, I think particularly on the efficiency as a service work. What's the sort of average deal sizes that you've been doing and sort of how many deals have you done so far? Just some statistics there would be helpful.
Great. We've completed projects in about 1,150 small commercial buildings, so mostly apartment buildings, a lot of churches, synagogues, mosques, some nonprofits, some schools. We always love doing schools where we can. The deal size can range, $50,000 in single family homes. We're in New York City, so, these are New York prices. But $50,000 for heat pumps in a single family home to, $2 to $3 million for apartment buildings.
Great. And then a quick follow-up. I think a really interesting question is, could a council of government organizations serve in the same role that BlocPower has served in order to facilitate efficiency as a service projects, kind of demand aggregation and market development, that sort of thing?
Well, I cannot advise you to try and replace BlocPower, but absolutely, you technically can fulfill that role. You can serve as, in effect, a building decarbonization intermediary that's going to analyze data, aggregate financing, perform construction project management. And you can play that role. We think that governments and nonprofits should play that role. And we are certainly willing to provide guidance as best we can to help folks do that. So just shoot us a note and we'd be happy to walk you through how we think it might work.
Thanks. And Mark, a question for you about kind of the process of managing a green revolving fund. Kind of what have you learned over the years of working on GRFs in terms of what skills are required, how much time it takes, who needs to be involved, those sorts of considerations?
Yeah, it's a really good question. So, I mean, it really can be spearheaded by a single individual. Many institutions, there's one sort of champion. That could be someone in a sustainability role, energy manager type role, a facilities person, some kind of other sort of programmatic or other sort of stakeholder. Typically, there's a single individual or a small group sort of works on this for, maybe a few hours a week for a few months. You're not talking about, needing hundreds of hours to get sort of this model off the ground. I mean, there's a lot of sort of example, guiding documents and sort of charters that you can put together that are just 2 or 3 pages long that explain how these funds work and how it'll run. You do need, buy-in from obviously a number of key stakeholders on the facility side and on the finance side to sort of make this all work. But you don't need any kind of special expertise. I mean, there's even students at some, colleges involved with, leading the effort to set up and run these funds. And many committees that run these funds involve students and other stakeholders in a higher education sector or other sort of different stakeholders in other sectors.
Awesome. Thank you, Mark. A couple more rapid fire questions for each person and then a couple general ones. Brenna, a question here for you about, let me just make sure I understand the question. So what about sort of commercial real estate investors that want to plan on doing energy efficiency capital improvements as part of sort of the acquisition of a new asset? Can you talk more about how the BEPC model or energy performance contracting can sort of fit in there in the commercial real estate world?
Yeah, it's a great question, and I think we're seeing this more and more. And we help real estate owners and operators basically embed retrofits into their underwriting. And how do they do that? One is they look at their property condition assessments providers and look at what they're including in those reviews of the asset and asking those or requiring those PCA providers to look at more efficiency and retrofits. And then you can plan for using an EPC on the other side so that you don't adversely affect your returns. Because I think that's part of the issue that comes up for investors. They say, hey, if I put in a bunch of capital in my model, I can't pay as much, won't get as good a return. So this is a way to not impact your returns and yet still get those retrofits done. And we're seeing that more and more through just embedding it in the due diligence process.
Awesome. Devesh, a couple of questions here about kind of some of the variation in PACE program design across states. And since the PACE model does sort of require legislation to be passed at the state level and then individual programs to be adopted at the county or municipality level, sort of how do you all think about the diversity of programs that are out there and standardizing those? Like from a financial markets perspective, how do investors and lenders sort of get comfortable with PACE given its diverse sort of profile across the country?
Well, I think organically, there are programs that the market feels are working well. Their volume is there because they're designed correctly. And I think, we just have to wait for some markets to have a better approach. Fundamentally, when you think about retrofits, if I've got a new HVAC system to put in a building that has a 20-year-old system, by virtue of making that improvement, by mitigating deferred maintenance, I'm going to have an energy efficiency improvement. So I think some common sense has to be built into how these things are designed. When you get too aggressive on performance standards, they have to be balanced with that reality, I think.
Awesome, thank you. Donnel, I want to dive a little bit more into the green bond model specifically. So you mentioned that you guys are using a green bond yourselves, but I think there's probably some folks in the audience who aren't quite familiar with what a green bond is, how it's different than a traditional bond, and sort of why you would want to do one of these things in the first place. So could you maybe start with how you selected the green bond model and kind of why it made sense for you? And then kind of corollary to that is, can anybody invest in a green bond, your green bond or other green bonds? And how does that part work?
Yeah. So one of the things that's been really fun for us is, we were fortunate to win a Department of Energy contract like six years ago when we were a new startup. I don't recommend doing Department of Energy contracts if you're a new startup to anyone, but the contract was to create a crowdfunding or crowdsourcing model for financing for energy efficiency in low-income communities. And so It took us a long time, but what we were able to do is eventually create a new financial product that anyone, whether it's Goldman Sachs or Barclays Bank or a grandma who wants to invest $50 in helping to put solar panels and heat pumps in the local library where her grandkids study, anyone can invest in building electrification. And so the idea of a green bond is we believe that green infrastructure is profitable. We believe it is the future. Wall Street already knows that. So they're going to finance it and make 6, 7, 8% returns. We want regular Americans to be able to make 6, 7, 8% financial returns. And we also want them to be heavily involved in greening local buildings in their local community. And so now if that grandma's investor in a green bond on her grandchild's, library, she might go to church that Sunday and say, you know what, I just invested $50 in greening the library. Why aren't we greening this church? Or why aren't we greening, the senior citizens community center or whatever? So we want regular Americans to participate as investors in a green bond, which is a financial product where 100% of the investment is going to be used to green low income or underserved buildings. So we're really, really excited about it. We just raised $1 million in the month of March for the initial green bond investment. So something like 400, regular Americans invested. They're going to make 5.5% rate of return, which is pretty good in this environment. And they're going to create a bunch of greenhouse gas emissions reductions and local jobs. So that's what the green bond is about. And corporate America seems really excited about it. And so we want to take that excitement and bring it to energy efficiency. Green and sexy, like Kermit. Green and sexy.
Love it. Great. And a couple folks asking about getting in touch with BlocPower. We will have the emails on the very last slide so folks can get in touch with Donnel and his organization. And then, Mark, one final question for you is given that you have this sort of wealth of data in grits from projects that have been completed both as part of green revolving funds and otherwise, what are some of the insights that have come out of that in terms of how to set up a good, effective green revolving funds, or what are some of the best practices you've been able to identify?
How much time do we have left? Right. So it's a great question, and I think it's complicated to sort of provide a quick soundbite answer. I will say, if you look at sort of where projects are being done, the 3,000 plus projects that are in the grits library at this point, a good majority of them are, as you might expect, lighting related and HVAC related. That seems to be the sort of the two main areas where people are really concentrating their efforts. There's definitely a great amount of sort of work on water related projects, waste reduction projects, renewables, and others. But at least as it comes to sort of use of the grits tool, that seems to be sort of the two sort of spaces that are really draw attention. In terms of sort of size, it's really all over the map. There's lots of multi-million-dollar projects that are really aggressive and ambitious, and there's lots of really, I would say modest projects that are $5,000, just upgrading, one set of lights to LEDs or something else, like something simple like that. So it really kind of comes in all shapes and forms. But I will say, in terms of an overarching theme, I think is that people are excited to move forward and excited about the idea of tracking and sort of demonstrating the impacts of this work, so that you can sort of accelerate and sort of build on the momentum that you're generating, rather than having to sort of start from square one with each project and starting all over again. So I think that's probably one of the the key themes to take away from all this.
Okay, that's great. Thank you for distilling that. And then one final question for everybody, just a quick rapid fire lightning round question. So please answer in one sentence. And the question is, if you could change one thing about the world to accelerate a deployment of clean energy financing to more people, more businesses, what would be the thing you would change to enable clean energy finance to grow faster? And I'll just let you popcorn, whoever wants to go.
Remove people's fear about it. Educate them.
I'll go the other direction. I'll say implement sort of aggressive mandatory building energy performance standards for all existing buildings in the US and internationally.
That's a good one.
Thanks.
Ban fossil fuel gas and oil in buildings, since it's giving everybody asthma and making us sick and killing the planet.
I would say build the potential for net zero and overarching types of how do you say it, go to the moon type goals into the standard analysis that's being done at the economic decision making, retrofits and new construction.
Nice, love it. Good answers ranging from the strategic to the technical. So thank you all. We just have a couple of final slides to wrap us up here, but thank you all for a great discussion. Wish we had a couple more hours to have it, but we'll have everybody's email at the end so you can follow up directly. If we want to go to the next slide, we do want to highlight some additional resources that are available on the Better Building Solutions Center. And so when the slides are made available later on, please, you can go ahead and click on these to view these resources related to the presentations today. And then if you go to the next slide, actually, I think we have a video for you here. So we want to highlight the Better Building Solutions Center, which has over 3,000 solutions to help you find proven and cost-effective strategies to help you reach your energy, water, and waste reduction goals. So let's go ahead and check out the Better Building Solutions Center video. All right, love it. Also want to highlight the Better Building Summer Webinar Series. So we'd like to invite you to join us for this pretty awesome webinar series. As you can see, there's a couple of sessions on here that touch on financing, including financing and higher education coming up. Partners are going to be discussing all of the issues that you care about and some of the major challenges that they're facing around energy performance and finance. So to register for that, go to the Better Building Solutions Center and click on Events and Webinars. And if we go to the final slide, I just want to take a minute to thank all of our excellent panelists. Here are their contact information as promised. We're also going to launch a short feedback survey in Slido, and please take a couple of minutes to give us feedback on this session. That's how we get better and make sure that we continue to develop programming that's the most useful for all of you, including stuff like this excellent panel. So please go ahead and fill out the feedback form, and that'll be open until tomorrow morning. And if you want to learn more about any of the resources discussed today, go ahead and visit the Better Building Solutions Center or shoot me an email at the contact information below. So Brenna, Devesh, Donnel, Mark, thanks again, and see you all at the rest of the summit.
Thank you.